Welcome all to FSA Learning Module 8, topics in long-term liabilities, EOCQs. Let's get right into it. Which of the following is a potential drawback of compensating employees with stock options? The idea of stock options is to align interests. Shareholders and employees get employees on board with maximizing shareholder value. If they hold stock options, they will want to maximize the value of those stock options and hence maximize shareholder value. But the grant may make employees adverse to risk. This is true. They don't want to take on big risks because they don't want to risk losing any value that the option has. B, the grant may make employees seek more risk. Yep, the downside of options in this scenario is their asymmetric payoff. The fact that once the share price drops below the exercise price, there's no further losses to be made. So they might actually seek more risk if the option is out of the money, trying to get it into the money. So they're both right, which means C is right. Both of the above are potential drawbacks, could go either way. Which of the following is typically an objective of a share-based compensation plan? What are we trying to do? Attract new employees? Well, it should do that. Maximizing executive compensation? No, it's about aligning interests. If you wanted to maximize executive compensation, you'd pay them an infinite $1 billion. It doesn't make any sense. C, alignment of employees' interest with those of management. Yep, it's all about alignment, but not employees' interest with management. It's about employees and shareholders. So not C, not B. A is best. Which of the following statements is true? Share-based compensation does not have to be treated as an expense. That's not true. It does. When no cash is exchanged, irrelevant. It's still spread over the service life of the employee, even though it's not cash-based. We'll have to estimate the fair value, spread it that way. B, share-based compensation programs can take a variety of forms, certainly true. Including those that are equity settled, certainly true. And those that are cash settled, certainly true. You might have compensation which is based on the share price of the company, but not actually shares. So I like B. C, employees will receive a benefit of the stock option as long as they work long enough for the option to vest. Well, that's not strictly true, because what if the option ends up out of the money? If it ends up out of the money, you get no value out of it. Answer is B. Which of the following is a difference between stock grant and a stock option grant? So we're granting literally just stock, or we're granting options. A, whereas the fair value of stock grants is usually based on the market value at the date of the grant. Certainly true. The fair value of option grants must be estimated. Also true. Difficult to work out the fair value of the option, even if the firm has traded options. Stock options, or employee stock options, I should say, are very different liquidity, etc. So getting their value is tough. You have to estimate it. I like A. B, companies account for stock grants by allocating compensation expense over the employee service period. Certainly true. Whereas compensation expense for stock options is expensed immediately. No, it's not. It is spread in exactly the same way. C, compensation expense is determined based on the market value of a share of stock at the grant date. True. We work out the value at the grant date, spread it, as we've said, over the service period. Whereas the measurement date for the value of an option is when the employee, nope, it's also at the grant date. That's not a difference. So it is A. Assume ABC Company, a fictional company, provides the following disclosure about its stock compensation plans. The average fair value of shares granted was 20.86, 16.42, and 17.80 in 21, 20, and 19 respectively. Okay. If the company granted 18,000 shares with a 3-year vesting period in 21, what is the annual compensation expense for the 2021 shares granted? Let's have a look. 2021, we'd use the fair value to estimate the compensation expense at the date it was granted. There were 18,000 of them. So that will give me the total expense. We will spread that over the 3-year vesting period. So 28.6 times 18,000 over 3, 125,160. Answer is A. Assume XYZ company discloses the following information in its stock compensation note. As of 31st of December 21, we had 630 million of unrecognized compensation cost related to non-vested stock-based compensation awards granted under the plan. So that still needs to be spread through the income statement as a cost. We expect to recognize this cost over a weighted average period of 3.2 years as stock-based compensation expense. But what is the expected compensation expense in 2025? So we are at 31st of December 21 now. So there'll be 1 year up to the end of 2022, the second year up to the end of 23, the third year up to the end of 24. So 2025 is going to get the very end of that period, the 0.2 years. So how do we do this? Well, I would take the 630, divide it by 3.2 to get the expense per year. That would be number 196875. And then in 2025, we are just getting 0.2 of a year. So 0.2 of 196875, 39,375, closest to A. A little math experiment. Beginning with the fiscal year 2019, for leases with a term longer than 1 year, lessees report a right to use asset and a lease liability on the balance sheet, only for finance, only for operating, or for both. Now, the reason I was hesitating there, it's right of use, but I think rather than being part of the question trying to throw you, that's just a typo. They mean right of use asset. And under the new standards, for leases that are longer than a year, unless they are less than 5,000 USD, that's the one exception you're allowed on IFRS. But other than that, everybody will have a right of use asset, so it is C. For a lessor, the world of lessor accounting, the leased asset appears on the balance sheet and continues to be depreciated when the lease is classified as. So the lessor is allowing somebody else to use the asset, but continues to depreciate and keep hold of the asset. That happens if it's an operating lease. The answer has to be C. Finance and sales type are two terms under US GAAP that describe a finance lease. Under US GAAP, a lessor's reported revenue, so lessor accounting, at lease inception will be highest if the lease is classified as a sales type, an operating, or a direct financing lease. While operating, they would keep the asset on the balance sheet and they would depreciate. Sales type and direct financing, they are both types of financing lease. Direct financing, all of your revenue is interest. For a sales type lease, you would take a profit on sale. For direct financing, providing these leases is your business. For a sales type, you make these products and you happen to be selling it on a lease. So the answer is A. You would take profit at its inception with a sales type lease. Not really covered in any detail in the curriculum at all. In fact, the curriculum says we don't need the detail on this. So that question, I think, is a little bit harsh. Under both IFRS and US GAAP, a lessor, we're in the world of lessor accounting, in an operating lease recognizes selling profit at lease inception. If it's an operating lease, the lessor retains the asset, keeps it on the balance sheet and depreciates. All they will do is have a lease receivable, which will get reduced by the cash they receive, just like receiving rent. So they're not selling, they don't get a selling profit. A lease asset comprising the lease receivable and relevant residual? No. They don't have a lease asset, they just have the asset because they retain it. Lease receipts as income and related costs, including depreciation, yes, because they retain the asset. As expenses over the lease term, it is C. Compared with a finance lease, an operating lease is similar to renting an asset. Is equivalent to the purchase of an asset, has a term for the majority of the economic life of the leased asset. It's A. I just paused there because I don't really think there's a need for the first bit of that sentence. Compared with a finance lease, we're not comparing and contrasting here. They're just asking what is an operating lease. It's similar to renting an asset. Equivalent to the purchase of an asset, that's finance lease. Has a term for the majority of the economic life, that would be an indication that we had a finance lease. So, has to be A. Under US GAAP, a lessee's accounting for a long-term finance lease after inception will include recognizing a single lease expense. No. If it's a finance lease, in the income statement we'll have two elements. We will have the amortization of the right of use asset, and we'll have interest on the lease. They will be shown separately, separate line items in the income statement, so it's not a single lease expense. Recording depreciation expense on the right of use asset, absolutely. There you go. Increasing the balance of the lease liability by a portion of the lease payment. No, you decrease it over time as you pay it off. Don't increase liabilities by paying them. It is B. A company enters into a finance lease agreement to acquire the use of an asset for 3 years with lease payments of $19 million starting next year. The leased asset has a fair market value of $49 million, and the PV of the lease payments is $47,250,188. Based on this information, the value of the lease liability reported on the balance sheet at inception, well, it's $47,250,188. At lease inception, you bring in a right of use asset equal to the PV of the minimum lease payments, and you bring in a lease liability, which is also equal to the PV of the minimum lease payments. So PV is there. Answer is A. It's not the fair market value, nor is it the total payments. Penben Corporation, that's a good name, has a defined benefit pension plan. I always check with pension plans that it's the complicated one. Defined benefit is. Let's just make sure they're not tripping me up. At 31st of December, its pension obligation is euro 10 million and pension assets are 9 million. So we have a PV of the obligation of 10 and assets of 9. Under either IFRS or US GAAP, the reporting on the balance sheet would be closest to which? On the balance sheet of the sponsor, we're not talking the pension fund accounts, we're talking the sponsor, we show one line, the net pension position. The net position here, assets of 9 minus obligation of 10, that is a liability. So we'll show a net pension liability equal to 1 million. A, 10 million is shown as a liability, 9 as an asset. Nope. 1 million is shown as a net obligation. That is true. Pension assets and obligations are not required to be shown on the balance sheet. Nonsense. They are, but it's one of those rare situations in the world of accounting where assets and liabilities can be netted off. So you just see the one. The information below is associated with the company that offers its employees a defined benefit plan, so it's the fun one. Fair value of the fund assets, estimated obligation, and PV of the estimated obligation. Based on this information, the company's balance sheet will present a net pension. We will net them off, and the net will be of the fair value of the assets and the PV of the obligation. So it's going to be the 300. There's only one answer that's 300, so asset or liability irrelevant, but assets are obviously greater than the liability, so it is a net pension asset of the 300. Answer has to be A.